The markets after Liberation Day. There has been a major shift in how investors and traders are choosing their safe haven assets. The US dollar is rapidly losing its safe haven status. But what's truly surprising is this. Even after the pause on reciprocal tariffs, US Treasuries are not being favored. Why is that happening? What is really going on in the markets after the 9th of April? Stay tuned as we break it all down. First, a quick disclaimer. This video is for educational purposes only. I am not a financial advisor, and nothing here should be taken as financial advice. What you're about to hear is my personal view, based on research, experience, and market observation. Always do your own research before making any trading or investment decisions. Welcome to Markets and Global Trends. Just after I posted my last video, I checked the markets, and there it was. A huge spike in the S&P 500 and other risk-on assets. I checked the news. Just hours after the Liberation Day tariffs came into effect, Trump made a surprise announcement on his Truth Social platform. He said there would be a 90-day pause on tariffs for all countries, except China. For China, the tariff remains at 145%. This move by the Trump administration, halting the planned reciprocal tariffs on most countries, led to a massive overnight rally in equities. The S&P 500 surged 9.5%, recovering around two-thirds of its losses from the previous week. Tech stocks recorded the biggest one-day rise since 2001, up 14%. The Nasdaq Composite Index climbed 12.1%. But the real pressure wasn't from stocks. It came from the bond market. The recent sell-off in US Treasuries and increasingly chaotic price action raised concerns among investors about the forced liquidation of basis trades. That pressure appears to have pushed Trump to quickly pause the higher reciprocal tariff rate plan. Just after it had gone live, Trump acknowledged that people were, in his words, getting a little bit yippy, a little bit afraid. The sharp rise in bond yields in recent days suggested investors were losing confidence. And then came the big quote. Trump said, "I can't imagine a further increase of tariffs on China. Business confidence remains low," but halting the tariffs was still seen as an optimistic move. To be honest, I always believed someone like Trump, who constantly cites the S&P 500 as evidence of his success as president, would never allow the US market to crash. This might have been the plan all along. Scare trading partners into negotiations, and then soften the tariff threat. Gold reacted strongly to the news. And it proves a point I've been making for a while. Gold doesn't rally purely on negative headlines like recession worries. Gold actually crashed when the reciprocal tariffs came into effect. It has its own fundamental rhythm, tied more closely to rate cuts or major geopolitical shocks. Remember, gold also crashed in the early days of COVID-19. So going long on gold isn't always the right move for risk-off days. You have to be selective and cautious. Now, let's talk about the FOMC minutes from the March meeting. They leaned modestly hawkish. There was broad agreement to keep interest rates on hold, with inflation still persistent. The Fed is firmly on pause. In contrast, the ECB is expected to cut rates by 25 basis points next week. That move is already fully priced in. Meanwhile, the latest US CPI reading came in lower than expected. But here's the concern. US Treasuries, considered one of the safest assets in the world, are being sold off. This is not a good sign during recessionary sentiment. It suggests that investors are losing faith in both US bonds and the US dollar, all because of the uncertainty around tariffs. The EUR-USD currency pair has been trending up. It's a clear signal that traders and investors are shifting away from the dollar and moving into the euro. The dollar's status as the global reserve and usual safe haven is now being questioned. The S&P 500 is barely holding up. Oil has recovered from the $56 per barrel level. Bitcoin is trading steadily around 80,000. On a different front, Australia is reopening free trade talks with the European Union. 2 years ago, those negotiations broke down due to disagreements over agricultural access to the EU's 450 million consumers. China, on the other hand, is facing deflation. They've been talking about stimulus since September 2024, but so far, it's all talk. Investors are waiting for action. It's time for China to walk the walk. The EU has also agreed to pause its retaliatory tariffs for 90 days. At the same time, China and the EU have begun negotiations to remove tariffs on Chinese electric cars. To counteract the 145% tariff from the US, China is now devaluing the yuan. In response to the global impact of Trump's tariffs, the People's Bank of China, Bank of Japan, and Bank of Korea held joint meetings. China, Japan, and South Korea also had a trilateral session to discuss financial and economic cooperation. Now, let's talk about safe haven currencies. The Swiss franc has officially overtaken the Japanese yen as the top safe haven. It's always been a reliable choice during uncertainty, but its proximity to the Eurozone and the current trader preference for the euro over the dollar has given it a major boost. So, the new safe haven hierarchy is number 1, Swiss franc. Number 2, Japanese yen. Number 3, euro. We're seeing that in the charts. Both USD JPY and USD CHF are dropping sharply. Meanwhile, EUR USD is on the rise. Before the Liberation Day tariff event, I had recommended a short CHF JPY trade, but given the current developments, that trade is no longer valid. Traders are now favoring the Swiss franc over the yen. I would not recommend shorting CHF JPY anymore. At this moment, the strongest currencies in the G10 currencies are: first, the Swiss franc, second, the Japanese yen, and third, the euro. Thanks for listening. If this breakdown helped you make sense of the markets, don't forget to like, subscribe, and drop a comment. Do you believe CHF will remain the top safe haven, or is the yen set to reclaim the spotlight? You're watching Markets and Global Trends.